Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 25 of our YouTube channel and podcast. And I could not be more excited to continue sharing my financial knowledge and my knowledge on personal finances and building good financial habits with you guys. Today, we are going to talk about a particular topic that again builds on the last couple days where we've talked about the investment principles of diversification and asset allocation, which both have to do with your risk return relationship. And that's exactly what we're going to talk about today, your risk return relationship and how that impacts your investing life. And so that's what we're going to dig into today. And I think it'll be a really interesting topic that will allow you to better understand how risk plays a role in the returns that you make in your investing life. Before we get too far, go ahead and go down below and click the big red subscribe button if you're on YouTube and like this video. Leave me some feedback in the comments. If you're on Apple or Spotify podcasts, you can subscribe there as well. That'd be really helpful, really useful. And then you can also check us out on social media at MNO with Dylan is how you can find us. Also, you can go to www.mnowithdylan.com and you can benefit from some of the resources that I have there, like financial coaching sessions and tools and resources for you guys to use that can help you through your financial action plan and your financial journey. So question number one is naturally what? It's naturally, what is risk? So here's what risk is. Risk can be defined as the chance that an outcome or investment's actual gains will differ from expected outcomes or gains. Okay, so that's saying the possibility that what you actually get is different from what you expected to get. So that makes some sense, right? Because anytime you take a risk, you are risking that an outcome is different from what you expected it to be. In reality, expected returns are hard to determine. It's hard to determine what returns to expect from particular asset classes over time. And so that's where this particular definition kind of falls a little short, is that expected returns are hard to determine. So in reality, the amount of risk that you take can lead to more returns, or it could lead to less returns, just given the particular action of whatever you invest in. So you have to keep that in mind when you are investing and when you are picking the assets that you invest in. But you don't want to invest in something that you don't have a good idea of what future returns should be. So you should have a general idea what you expect to gain out of a particular investment. And if you don't, then it's much more like gambling or speculating, because you're taking a bet that something is going to go one way versus another. And that's not what we want to be doing. We want to be doing our research, doing our homework, and investing with some knowledge and some basis for our thoughts. Some define risk also as the possibility of losing some or all of an original investment. And that's a decent definition as well, but it has its limitations too. Because you can invest well and still lose some of your money in some cases. Now, this is talking about the possibility or the probability of that outcome of losing on your investments. So that's why I do like this definition the best, because it really bears into what risk aversion is and being risk averse. Being risk averse is saying that there is too much risk, therefore I'm not going to invest, or too much risk, therefore I'm going to invest differently. And so that's the whole point. The whole point in investing is you don't want to lose the amount that you invested. So that's why I like this definition, because it really ties into what we're really trying to do when we're investing. We're trying to gain on what we invest and not lose what we invested. And that's exactly what this definition is saying. And so risk is usually determined by historical behaviors and historical patterns, because it is so difficult to determine how much risk you're really taking or what you really should expect if you don't look into the past. There's no telling what you can think about the stock market or certain types of investments if there were no prior knowledge of what those things had done over the long term. Those give you more ease. I've told you before that knowledge is power with investing. When you have more knowledge and you have more background as to how investments work, then you can invest with more confidence. Well, that's because you understand the behaviors and you understand the past. And we use several different measures to tell us how risky something is. So, in a lot of cases with investments, individuals will use standard deviation of returns. And what that is nothing more than taking all the returns and taking the standard deviation of them to tell how variable the returns are over time, therefore, how risky they are. Similarly, individuals can use beta. And what beta is it is a measure of variability relative to a market or relative to an index. And so a lot of times when you're looking at beta greater than 1, that means more variable than the particular market or index that you are comparing with. And then less than 1 would be less variable or less risky than the market or the index that you're comparing with. And that's used very commonly in stocks and in investing in stocks. And so there are several different types of risk that can be taken into account. And so here are just a few of them. So we've got credit or default risk, meaning it's the risk that a firm is not going to be able to pay their bills, right? There's interest rate risk. So if you're investing in fixed income securities or bonds, interest rate risk is a real deal, and it can also be in stocks as well, because a lot of things are driven by what the interest rates are. So there's interest rate risk. There's business risk, which is just the risk inherent with the business that you are running, right? Then there is country risk. So there's risk that is inherent to the country that you're operating in. And then there's political risk, which we see a lot of in this day and age, which is relying on the decisions of politicians and how that might impact your investment. So all of those things are taken into account. And then there's these two big buckets of risk as well. So systematic risk and unsystematic risk. So systematic risk refers to the risk inherent to an entire market. So to the entire stock market, there's a systematic risk. So this is undiversifiable risk, because we talked about this before, that diversifying can take away risk. Well, not this risk. This risk is going to be inherent no matter what. There is going to be systematic risk. So this is risk that's going to be there, and you can't diversify it away. This type of risk can only be mitigated by hedging strategies or certain types of asset allocation, because you may get into other types of assets that will allow you to be less correlated with the particular things in that market, or in the stock market, if you're invested in other types of assets. So there's systematic risk, and you can get out of it in those ways. But if you're just invested in stocks, then systematic risk is going to be there. If you're just invested in bonds, then there's systematic risk that is going to be there, and you can't get rid of it unless you take some asset allocation or hedging type strategies. Then the type of risk that we've really been talking about recently in the past couple of videos is unsystematic risk. And so unsystematic risk is this diversifiable type of risk, or this firm specific type of risk. So when I'm talking about diversifying away risk within an asset class, what I'm doing is I'm taking away some of this unsystematic firm specific risk, because if one firm is not correlated with the other as far as their stock, well, I can take away some of the specific risk of this firm by also owning this firm. And these are important because both systematic and unsystematic risk play a part in your portfolio, and you have to know what you're trying to get rid of and where the risks are coming from. So we've talked about what is risk. Let's talk about what returns are real quick, and some definitions for what a return is. So let me read some of these off to you. So the first one is money made or lost on an investment over some period of time. Obviously, makes perfect sense, right? It can also be the change in dollar value of an investment over time, and can also be expressed as a percentage derived as a ratio of profit to investment. And that's extremely common. You see the return as a percentage of what you invested. So that's a very common thing as well. And these returns that you see, especially those as a percentage, they're often annualized for comparison purposes. So if I receive a return on a stock that I only held for 7 months versus somebody who held something for 13 months, then they annualize those returns to see who did better. Because if I made a 10% return over 7 months, then annualized, it's going to be greater than 10% because I made that in less than a year. But if somebody else made 10% over the course of 13 months, then their annualized return is going to be less than 10 because it took them longer than a year to make that return. And what's particularly cool about this is that your annualized returns can allow you to make a lot of the assumptions that we make when I talk about investment projections and how much money you can have moving forward, or how much money you need to invest to get to where you want to get to. And all that is using annualized rate of returns and just growing your money forward by those particular rates. And returns can also be looked at as real versus total returns. So a total return would be the total amount of money that you made on something. So if I invest $100 in something and I make $20, then I make 20%. My total return is 20%. But let's say over that course of time, let's say that's a 1-year period. Let's say inflation was 3%. Well, my real return is going to take inflation into account. So I'm going to take 1 plus my actual return, or my nominal total return, and I'm going to divide that by 1 plus the inflation rate, which is 3%. I'm going to take that minus 1, and that will give me what my real return actually is on that investment. So my inflation adjusted return is my real return. And a lot of people want to know their real return because that is the actual amount that your money is increasing in what we call purchasing power. Meaning that inflation, if it's tracking the increase in the price of goods, then you need to outpace inflation for your money to actually be growing, to actually be buying you more stuff in the future. So we've already talked about it a bit in previous videos, but there's this trade-off and this relationship with returns and risk, right? We want the least amount of risk that we can have for a particular expected return. And that's the goal. The goal is to take as little risk as possible to get to where you need to get to, because you don't want to overdo it, and you don't want to be taking risks that are unnecessary to get a particular return. You want to take the least amount of risk you can to get to the return that you want to get to. And the relationship is commonly more risk, more return, less risk, less return. And let me give you an example of how this works out in a gambling setting. And investing is not gambling, but this gives you a good vision of risk and return. So I'm going to read this off. And this is about Mike Tyson and Buster Douglas. And a lot of people know this fight well. This was a fight where Buster Douglas was a huge underdog. Mike Tyson was killing everybody. And so then they fight. And Mike Tyson was supposed to obliterate Buster Douglas. And Tyson was he was a 42-1 favorite. And what does this mean? This means that if you were to bet $1,000 on Douglas, and he won, which he did, you would have made $42,000 on that $1,000. And why is that? It's simply more risk. You took the risk of not investing in this case, but betting on an individual who shouldn't have won. And this is similar to if I'm going to invest in a penny stock, right? Or a stock that is really small and I don't know a ton about, because I think it has huge upside potential. Then you invest in this thing and you don't have a high likelihood of success. But if you do succeed, your returns are going to be outstanding, just as they were if somebody were to have invested, which some people did bet on this Mike Tyson Buster Douglas fight. And so what do we figure out here? More risk, more return. The more that something is not likely to go your way, then the more you're going to be compensated when it actually does go your way. When it comes down to it, though, this trade-off between risk and return has everything to do with you. It doesn't just have to do with what theory says or what you think you should be doing. No, it has everything to do with you, because your particular risk profile, it tells the story. It tells where you should be investing. It tells what types of risks you should be taking. So it is dependent on you. It's not dependent on what somebody else thinks or what somebody else says. At the end of the day, you may be willing to take less risk and the lower returns that come with that less risk and be perfectly okay with that. And that's fine. And maybe that's what can help you sleep at night. But you may be willing to take on more risk and more variability in order to get to higher returns. That's okay as well if you're doing so in a prudent way and you're doing it with proper investment analysis. I have no problem with either of those situations because it has to do with you. It has to do with what you're willing to do. And the nature of things in most cases is that the more you know, the more you understand what you're invested in, the more risk that you are willing to take. And there are certain situations where you shouldn't take too much risk or have too much volatility in your portfolio. But otherwise, we want the best returns we can get for the lowest amount of risk. That's the point. Now let's ask this. Does more risk always mean more returns? Absolutely not. Let's go back to the Mike Tyson and Buster Douglas example. What if Mike had won and you had bet on Buster? Well, you lose all your money, right? Because that greater amount of risk didn't necessarily mean you had a good likelihood of those returns. But if the good outcome does come, then you were going to win, and some individuals did. But how do we know that this risk-return relationship does hold in most cases? Well, let's look at the example of small firm stocks versus large cap stocks. So small cap stocks over the long term have outperformed large cap stocks. And why is this? Because smaller firms are inherently more risky than larger firms. And that's not to say that a large number of small firms haven't gone bankrupt and a large number of small firms haven't performed very poorly, but the ones that have performed well have far outperformed those of the larger stocks because they were more risky. There was more risk inherent to them, so those who invested got the returns that were inherent to that risk. So there are some investments that are, and actually quite a few, investments that are riskier yet return less, but on average, more risk is going to bring you more return in the long term. I do want you to know that simply return chasing by taking on a lot of risk is a particularly dangerous thing to do. I don't want you to get stuck in this. I don't want you to put all your money in a really small company stock, a really small particular company that you're taking a bet on. Once again, we're not speculating, we're investing. We want to do our analysis and have this promise of safety and adequate returns that are going to come with what we invest in. Another way you can keep from doing this is to remain diversified. Allow yourself to take away some of the unnecessary risks by diversifying yourself out, like we've talked about in the previous videos. And you must remember, a lot of things that do offer high returns do so because they are inherently risky. So I'd like to talk here about like junk bonds, which are nothing more than riskier debt. This is debt of companies who aren't as likely to pay on this debt. And if they don't pay, well, you don't get paid. But this debt offers higher returns than the debt for companies that are more financially stable. Why? Because there's more risk associated with this particular company. And the same thing goes for us. If you have a really high credit score, then you're going to get a lower interest rate. It's going to be less costly for you to borrow than it would be for the individual who has a very low credit score. Why? Because the bank is saying, I need to make a higher return for the risk I'm taking for this individual with the lower credit score. So what are some practical ways that we can earn higher returns by taking on a little more risk? Well, one way in particular is being stock heavy. So having more of your money in equity investments than fixed income investments. That's a particular way you can do so because you're going to have a little more variability of your returns, but long-term returns have been better historically. So you can pick up returns there. You can also invest in small cap stocks and small cap funds and things like that. That will allow you to also take on a little more risk because, in some, those smaller companies are going to be more risky, but they will, or they have in the past at least, and they should, based on this risk-return relationship, return more in the long term than larger cap stocks. Additionally, you can invest in emerging markets and international funds and stocks. And these may have risks that are associated with them that aren't inherent to U.S. companies and aren't inherent to larger companies in larger economies. And you can invest in those, and those will likely return higher as well. Also, to make sure that you can earn higher returns based on the risk that you're taking, don't buy overpriced things. Just because you think something's going to go up in price doesn't mean that you should buy it. That is simply speculating. We want to buy things that have value and that we can purchase for less than what we think it's actually worth, and allow it to increase at least to what we think it's worth in order to make the returns that we want to make. And then further, just don't believe the hoax that there are really low risk investments that are going to have crazy high returns. I hate that. I hate that there are these individuals who, in many cases, are lying to you, one, or trying to con you in some way, or they simply don't understand what they're selling you, who will promise you all of this safety for an equally high return. And that's just not possible. It doesn't happen. Individuals and companies, especially companies, have to be compensated for the risk that they take. And you, as an investor, are going to be compensated for the risk that you take. So, for instance, with a fixed income investment, the reason that those aren't compensated, those investors aren't compensated the same as equity investors over the long term is simple. And it's because a firm raises debt, right? So they raise money via debt in order to perform better. Well, if you're an equity holder, if you're a stockholder, your performance is directly tied to that of the companies, right? So if I'm going to take on debt to try to perform better, then the cost of that debt has to be less than the increase in value that I want to create. Because if not, then it would have been stupid to take on the debt. So naturally, those returns, the performance has to be better to justify the cost of the debt. And so it's that simple, that if I'm going to borrow money, so for instance, some people borrow to invest. I do not suggest this, but what's the reasoning behind them borrowing to invest? It's that they think, okay, I can borrow at 4 or 5% and invest and make 10, and so there's a difference. And the same thing is the case here. This is exactly what I'm talking about, is the spread, the difference. And that is why those fixed income investments are going to underperform the equity investments over the long term. And so I hate when the individuals think that they're going to take no risk or very little risk in certain things like fixed income investments or annuities or things like that offer safety, and make as much return as you will on the equity side of things. You're just not going to, simply because the idea is that firms are borrowing in order to make better returns than the cost at which they borrowed. That's just a natural common thought that it should make a lot of sense. And whatever you do, run from people who offer returns with no risk. If they're saying, oh, you make all this money, there's no risk, there's zero risk, there's no risk associated with it, run, because there's always risk. There's always risk associated with investing. There's always risk associated with putting your money somewhere where it's going to grow, regardless of if it's high risk or low risk. That may be what they're trying to get across to you, that it's low risk. But if they say there is no risk associated, they are lying to you. There is risk associated with your money sitting in the bank today, because every bank in the nation could shut down. And there's not a high likelihood of that happening, but there is a low risk. And so don't ever let anybody tell you that there's no risk associated with investing, because there always is risk. So don't get caught up in those things. Don't get caught up in the things that sound too good to be true, because they are. So naturally, when I was an investment advisor representative, what I would hear so much from clients is that they wanted all of these returns, but they didn't want to take risks. And they loved when they were making great returns, but then when, the market dropped 10%, they were calling me and, having to, figure out, okay, well, what do we want to do and how do we, because their risk profile didn't necessarily match what they were invested in, but they had to be invested in those things in order to meet their needs or whatever it may have been. And so there's this delicate balance between the needs and the risk profiles, and being able to play this risk return game with your clients or with individuals like yourselves. And so just bear in mind, if you're an individual investor, that you have to be able to live with some type of risk, and you have to be able to live with some type of return. And that relationship has to play well and let you sleep at night and meet your needs. It has to do both. It can't just do one or the other. That's the problem. The problem is that a lot of people will invest because they need to meet their needs. They have to meet their needs, right? But in the process, they're not sleeping at night. That's a problem, right? You need to both meet your needs and be able to sleep at night. Well, some people don't have that luxury because they haven't saved well for retirement or for the future. That's why I implore you guys to invest early and do all the things that I've said before, because what really matters in your investing journey is that you're actually investing and putting money in. And we want to be able to play this risk return relationship and have the lowest risk for the most return. Of course, we want to do that. But none of that matters if we're not investing in the first place. So make sure you're putting money in, setting yourself up well to live a retirement and to live a future that is what you envision it being. So just know risk is going to happen, and your returns are going to be heavily correlated with the risks you take. Don't freak out. Learn as much as you can, and those risks will seem like a lot less. But don't ever get blind to the risk, because that can be dangerous too. Have a good respect for the risks, but also have the knowledge to where you can take risks that are useful to you and useful to your long-term returns and your long-term wealth building, while still making the returns that you want to make. So hey, thanks for watching this video. Don't forget to subscribe down below. If you're listening on Apple or Spotify, subscribe there. Also, like this video. Leave me any comments. If you're on Apple or Spotify, leave me a review there, and I'd be glad to see some 5-star reviews there. So put them up. Also, if you can, follow me on social media at MNO with Dylan. Check out my website to see the resources and the financial coaching services that I offer. www.mnowithdylan.com is where you can find that. Also, tune in tomorrow. I'm going to post a weekly rewind, and this will be the last weekly rewind that I post, at least for a while. What I'm going to start doing is posting clips on the weekend that are very similar to what I do in the rewind, but it won't be a whole another 30-minute video. It'll just be, particular videos that are 4, 5, 6 minutes that you can go watch and really go through quickly and not have to worry about clicking on a video that's 30 minutes and maybe a little more intimidating to watch, and you can catch up and see what you missed in that way. Then also tune in Monday as I talk about the last of my investment principles that I want to go over, and it's all about keeping investment fees low and why that is so important to your investment life moving forward and growing your money in the most efficient way possible. So hey, thanks again. Thanks for watching this video. Thanks for tuning into my channel. I really appreciate every one of you for watching or listening or whatever you're doing. Thanks for being here. Thanks for watching this episode of Money's No Object. I am your host, Dylan Howell. God bless.